Welcome to this segment of GTM Training Shorts presented by GTM Training Institute, your source for comprehensive income tax compliance and tax provision learning and development. My name is Frank Nieves, Director and Practice Leader. Corporate tax can be complex, and understanding its terms and concepts can be challenging. GTM Training Shorts aims to simplify complex content into concise and comprehensible segments. In this short, we will address the question, what are the U.S. information reporting forms for international operations? Listen to Bill Shiraz, Senior Manager, ITS Practice, as he explains.
Thanks, Frank. So U.S. companies with certain foreign operations are required to disclose those activities on a few different forms that you may have seen in practice. The main forms we'll be discussing are Forms 5471, Forms 8858, Form 8865, and Form 5472. So there's actual and deemed inclusion. So when we say these are information reporting forms, that's only half true, right? There's a quantitative analysis that happens, and some of these income inclusions and potential deductions get reported on the U.S. tax return. And there were provisions from the TCJA, which is the Big Tax Reform Act of 2017. Mainly, we're talking GILTI, FDII, and B, and they factor into a company's tax liability. But they're also subject to different effective tax rates, right, depending on the company's overall tax structure and their attributes. We do want to point out that after 2025, those deductions related to GILTI and FDII are set to decrease pending any new legislation. So companies that meet any of these, criteria may have to report these items on their tax return. Another reason why this information reporting is so important is that civil penalty regime. So failure to properly report, both not reporting at all or reporting inaccurately, could subject the taxpayer to $10,000 penalties, and that is per form per year. We also want you to note that Form 5472, as of, I believe, 2018, is now subject to a $25,000 penalty itself. When reporting these entities, it's important to know the different types of foreign entities. A foreign corporation is a regarded separate entity for U.S. tax purposes, and like corporations, they maintain their own attributes. So we're talking about earnings and profits and tax methods and different things like that. Foreign partnerships flow through directly to their owners, not maintaining their own E&P at their level. Similar to a foreign branch, as an entity that is operating in another jurisdiction, not through another legal entity, may be required to report in that local jurisdiction, and for U.S. tax purposes, report themselves as a foreign branch. A foreign disregarded entity could be a legal entity that is treated as a branch either de facto or by U.S. tax election, and would be treated for tax purposes similarly to that branch. We also talk about hybrid entities and reverse hybrid entities, which are basically entities that have a different treatment for U.S. tax purposes and foreign tax purposes. For example, a corporation in one jurisdiction and a flow-through in another jurisdiction. Here's an organization chart where you can see how these different filings would look, whether you have a foreign branch filing, whether you have what we call a CFC, which would require a 5471 filing, whether you have a legal entity that's made a check the box election, that would be that rectangle with a circle inside of it, that would lead to a 8858 filing as a foreign disregarded entity, or if you have an interest in a foreign partnership requiring an 8865. Foreign-owned U.S. corporations with certain types of transactions would also have that Form 5472 filing that you see at the top.
For more information on what is reported on the discussed forms, check out our Intermediate Corporate Tax Compliance Program, scan the QR code or email me for additional information or to suggest a future topic. Don't forget to like and subscribe below.